Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we introduced the concept of leverage and how this tool can be used to amplify both the gains and the losses on one's trading account. In today's lesson we're going to continue our Forex trading course with a look at how to use leverage in the Forex market. So let's get started.
As we discussed in our last lesson, many people put down 20% in cash to obtain their mortgage, which puts their leverage at 5-to-1. The 20% down payment that many homebuyers put down to obtain their mortgage is the equivalent to the margin that a trader puts up to purchase a financial instrument such as a currency pair when trading on margin. Most Forex trading firms will offer leverage of up to 100-to-1 or more, which requires traders to put up only $1,000 in margin for every $100,000 in positions traded. If fully used, this would take a 1% move in a currency pair and turn it into a 100% gain or loss on the value of your account. The easiest way to understand this is by seeing it in real time by logging into our real-time demo trading accounts. If you've not done so already, I encourage you to pause this video now and click the link above this video if you're watching on InformedTrades.com, or to the right of this video if you're watching on YouTube, and register for a free real-time demo so you can follow along as well. Once logged into the platform, in the upper right-hand corner you should see a window that says Accounts. In this window from right to left, you should see the following columns. The first column is the Accounts column. This lists your account number, and if you were trading multiple accounts, the other accounts you were trading would be listed here as well. The Balance column. This lists the amount of money in your account, not including any profit or loss on open positions. The Equity column. This lists the amount of money in your account, including any profit or loss on open positions. Day P&L. This is the gain or loss on any open positions for the trading day, which begins and ends at 5 p.m. Eastern Standard Time on this particular platform. The USD MR column. This stands for Used Margin, and is the amount of money in your account which has been allocated for margining your open positions. If you have no open positions, this column will read 0, so go ahead and click the dealing rates and open up a one contract position. If you have multiple positions open, go ahead and close out the additional positions by clicking on the close rate in the close column beside those positions so that you have only one position of one contract open. Once you do this, you should see the amount in the used margin column at $1,000. If you remember from our previous lessons, we are trading a contract size of 100,000 of the base currency, which puts the leverage which has been extended to us on this particular demo account at exactly 100-to-1 for currency pairs in which the US dollar is the base currency, and somewhere near 100-to-1 for currency pairs in which it is not. In the next column over, you should see a column that says USBL MR, which stands for Usable Margin. This is the amount of money that you have in your account, including any profit or loss on open positions, that is over and above the money allocated to margin any open positions in the account. Another way of looking at this column is that the usable margin column is equal to the equity column minus the used margin column. If the number in this column drops to 0, then the trading platform will automatically generate a margin call and close the open positions on your account. With this in mind, it's important to always have a clear understanding of how much money you need in your account to open each new position so you do not over leverage yourself, or worse, end up in a margin call situation. We are going to get into more in-depth examples in our next lesson, But to quickly demonstrate the relationship between the used margin and the usable margin columns, let's left click in the dealing rates window and open a 2-lot position of euro-dollar, which will bring the total in our account to 3 open contracts. Once that position is open, the number in your used margin column should have gone up by 2,000 to account for the 2 additional contracts we just opened, and the amount in your usable margin column should have gone down by 2,000. As we discussed in our last lesson, not respecting the amount of leverage offered in the Forex market is probably the #1 reason why many traders not only fail when trying to trade the Forex market, but lose their entire account balance. While the market is not a volatile market in and of itself, you can turn it into a highly volatile instrument by upping the amount of leverage used, which puts your account balance and therefore your trading career at risk. That's our lesson for today. In our next lesson, we'll look at several examples of leverage at work on our Forex trading demo account so we can start to get a feel for what an appropriate amount of leverage may be. So we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comment section below. And good luck with your trading.